evening, everyone, and welcome to my Facebook Live tonight. And I'm going to talk about financial market. And my main topic tonight is derivative market securities. So we're going to talk about the basic and foundational stuff on what is derivative market securities. But first of all, I would like to shout out to all my friends. Financial market class, how are you guys? I hope you're watching here right now. And my friends in business from JCI Central Davao, Zurich, Christian Marfori, Kenny, Sergio Bragan, how are you guys? And some of my friends are Toastmasters. So Joe Marie, most likely stocks, bonds, treasury bills, treasury bonds, and oil, wheat, basically everything that moves around in our current society, especially the oil, which I am going to talk about later in depth so that you would understand as to why the prices of oil increase and decrease, okay? So, first of all, to give you a definite understanding, comment. Okay. So, the derivative itself is a contract between two or more parties, and its price is determined by fluctuations. So, the prices do change. Now, here comes the main basis of the derivatives is the forward contracts, which I'm going to talk about later in depth. Now, derivatives can either be traded over the counter or in an exchange. So there are many different market indexes or exchanges around the globe. One of them here is, for example, Philippines Stocks Exchange. And these forward contracts are not standardized and unregulated, while future contracts are the ones that are regulated and standardized by each other. Now, first of all, before I'm going to talk about that, let's have a bit of a historical, on the history of this, on where derivative markets began. So, mainly it was used during old times as a livestock. Now, people during the old times do it on a simple handshake agreement. Now, today we have contracts. So, for an example of the contracts used in derivative securities are forward and futures contracts, which is I'm going to talk about in depth later. Now, next, what is a spot market? So, a spot market is one of the markets where derivatives are traded. Now, meaning spot. There is a spot price. Now, the spot price, for example, or they are called also physical or cash markets. So, it is where financial instruments such as commodities and securities are traded for immediate delivery. Now, delivery is the exchange of cash for the financial instrument. Wow, hello to my friends. Thank you for viewing my live feed tonight. I hope you learned something. Anyways, so these are traded in a over the counter or on exchanges, just like what I said earlier. Now, on spot market, there is a spot price, so it is immediate. So, for example, the price of the oil right now is, let's do it on a Philippine basis, is 56 pesos a liter. So that would be the spot price of the trade. Now, here comes the forward contract, which I'm going to discuss earlier, how it works. Now, forward and futures contract, well, what makes them the same is that they are both agreements that deliver a specified asset. So, our specified asset here is the oil, the gas, at a future date. So, prices are both tied to the current price on the spot. So, the on the spot price is 56 pesos. So, that would be the on the spot. Now, the forward or the future price will be based upon the agreement of the two or more parties. It depends. Now, spot contract agreement to purchase or sell an asset immediately based on the spot price or agreed price. Now, what is a forward contract? Let's talk about the forward contract, because the forward contract is, once you understand the forward contract, understanding derivative securities is much easier. So forward contracts are very popular because they are unregulated by the government. They provide privacy for both the buyer and the seller, and they can be customized to meet both the buyer and the seller's specific needs. Unfortunately, forward contracts or the size of the forward market is basically unknown. Why is it unknown? Because it is a private agreement. We won't know how many deals, transactions between two financial institutions or companies happen on a day or day-to-day basis. So what makes it good is, well, there's also an advantage because it's private and unregulated. There are no clearing houses that monitor the transaction. The only risk is that if the counterparty or the other party would default. So meaning when they would default, they would not follow up to the contract or to the agreement. But it is protected by a hedge, which I will explain later. Now, futures market. Futures market is a contract or legal agreement to buy or sell a particular commodity or asset at a predetermined price. It is still the same with forward or futures, with the forward contract, but it is regulated and legitimized. It has a clearinghouse which monitors it on a day-to-day basis. So there is a market to market daily. So it has been marked, and the price is every day when the market opens, when the market closes, there's an opening price and a closing price of the product. So for example, the oil is priced at the opening when the market opens at 52. When the market closes, it is now priced at 56. So every day on the day-to-day basis, it is fluctuating. Now, on the futures exchange, the buyer of a futures contract is taken on the obligation to buy the underlying asset. So an example of underlying asset again is an oil. So let's focus on the oil as an underlying asset. Now, when the futures or contract expires, the seller of the futures contract is taking on the obligation to provide the underlying asset at the expiration date. So for example, there is a company in Dubai that sells oil. Now, they're producing oil for the next year 2020, they're going to produce, let's say, 78,000 barrels of oil. Now, the price per barrel would be, let's say, I would price it at 500 pesos. Let's just say it's 500 pesos, guys. So 500 pesos. Now you times that up to the price of each barrel. So let's just say on my estimate around. Let me use my calculator, okay? 500 times 500,000 is equal to, let's just say, 250 million. So the value in which the buyer would pay to the Dubai oil company would be 250 million. 250 million. That would be the, let's say if it is a forward contract, that would be the price they would buy at a specified date. Let's say January 1, 2020. So at January 1, 2020, they would buy it at that specific price. The spot price on the price when they had an agreement upon, which was, let's just say the date was July 1, 2019, or today. Like they agreed today to buy it at that price at 500 a barrel, the 500,000 barrels of oil for Philippines, Shell. Let's just say it's that like that. Now it is a forward. Now because it is a forward agreement, so it is a private agreement. Now there is a chance that either of the party or the counterparty would default. Now that is the risk that the risk that the other party or the two parties are willing to take, which are protected by the hedge. Which are protected by the hedge. Okay. Which is protected by the hedge. Nag-message siya. Wait lang. Okay, go. So, after that, I'm gonna talk about which one is better or which one is, for me, on my opinion, is because I'm a person who is trading and investment is varying from each person. There are a lot of person out there who is like a risk taker, very aggressive investor. So if you're that kind of person, most likely you would trade into forward contracts or forward markets. And if you're more of a secured person, don't like to take big risks, you'll probably do the futures contracts or future markets, which are standardized and regulated. But let me talk about first the advantages and disadvantages before we're going to talk about that. And as an investor, how would you make a decision to invest on those kinds of markets? Now, generally, these markets are done by big companies, investors, corporations, FIs or financial institutions. Most FIs, by the way, just to give you a FYI, what they usually do is they do forward contracts or private agreements between two parties or two different financial institutions. You know. So, anyways, I'm gonna show to you right now which one is better and which one is for your own good. So, anyways, future and forward contract differences are their advantages would be futures are traded on exchanges, as we all know. They're making them standardized contracts, and they have clearing houses that guarantee the transactions, which drastically lowers the probability of default to almost never. It never happens. No party defaults. Now, second, they're monitored and regulated. So, well, since they're monitored and regulated, there's a lower risk, but so it was basic business investment. Low risk, low reward. High risk, high reward. And delivery usually never happens. Settlement for futures contracts has too many dates. Oh yeah, there are too many settlement dates, like on a day-to-day basis. So since they mark it on a daily basis, the prices, the fluctuations, so the settlement also changes. Due to being mark to market, daily changes are settled day by day. And prior to maturity, so maturity means the expiration date or the deadline of the contract before an agreement happens, where the company either solds or buys the asset, the underlying asset, which is the oil, in our topic. So a few days from that, it is then closed. Now, on forward contracts is the advantages would be like private agreement between two parties. So there would be there's no third party, there's no government, there are no clearing houses who would monitor you. So it is upon what the two parties have agreed upon on a forward contract or a forward market. Now, it's usually traded on over the counter, so yes, it is on the spot. The spot price would be checked. For example, it's 56. So they're going to make an agreement on the contract, which is they would buy it at a specific price based on the spot price. So it could either go higher a little bit or it could go lower. It depends on the agreement, actually. And then second is there's only one settlement date. That's it. One settlement date, and is delivered. So there is a delivery and cash settlement. So it is, if you wanted to buy the product, you got the product, you got the asset. That's it. And the best thing about, I forgot to tell you now, the best thing about the forwards contract is it is secured by a hedge. Now a hedge is like companies do get the hedge in order to eliminate volatility of the asset's price. And I would say the disadvantages would be risky. Well, the main disadvantage would be the other party might default, so they wouldn't follow up to the contract. And because it's a private agreement, no clearinghouse has to regulate. That's only the danger there. But most financial institutions do the forward contracts. I think it's because it's easier, it's private, it's just on a corporation or company basis. So anyways, I hope I gave you an understanding on what is happening in our society right now also, because the prices of oil is, fluctuating. It's getting higher, lower. It depends. Maybe it's seasonal. Well, anyways, I hope you learned something today. I would like to thank everyone who watched it. And for me, by the way, I would, as an investor, I would go to futures contracts or future markets. I would invest in future markets just because it is safe and it is secure. But there are also risks. Every investment is a risk, by the way. There is no clear, there's no crystal way of earning money or growing our money. Let's just learn and learn until every mistake, every failure is a feedback on learning. Now, guys, thank you to my friends in financial market class. I hope you learned something new. Thank you to those who watch and support this live video. And if you want to learn more about investment, not just in derivative market securities, you can check out websites, investopedia.com. You can also follow me on Facebook and Twitter and Instagram. Thank you all to those who view my live feed right now, to my friends in JSI Central Davao, to my friends in Toastmasters, my friends in business, especially to the people I've met in the last 5 years who taught me about financial strategies and how to build my my current lifestyle right now. Anyways, wait, to my friends in Manila, Meljan Aguilar, also a financial coach. Thank you very much, Sir Yuri. Well, Sir Yuri is a top networker. Yeah, he's in a networking company, but is very successful also in forex, in trading, and also a good advisor in financial business. Also to Dwight Malshapna, I know you're always posting stuff on social media. Your social media is getting good, man, and I'm just starting right now. Well, I hope I will do this video again. Guys, please support me. You can message me on Facebook or follow me on my Twitch account. I also do live videos on my games. I play Apex Legends. Well, you can also PM me if you ever need something, any advice based on spiritual. To my brother, Zaid Alpiolo, Flash, okay, Flash. Thank you very much. Goodbye. Have a good day, everyone.